Last week we talked life insurance loans, fixed loans versus participating loans. Can you get arbitrage? All the details that you want to know about. Be sure to check that out. This week, we're talking buy term and invest the difference. Should you do it? This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with Net Wealth Finance.
All right, buy term and invest the difference. You hear this all the time. What are your initial thoughts on this?
I think most people in the financial space are going to say some variation of this. And it's because term insurance is cheap, and they'll say that life insurance is only needed for a limited number of time or a limited amount of time, a term. And after that, you can self-insure, or you'll have your retirement and you'll build up enough assets or whatever it might be, and there's no need for it. And I think I just foundationally disagree with that. I think there's various reasons that we'll get into in this episode, but that is generally what you'll hear about.
I think buy term and invest the difference, a lot of that comes down to what are they getting paid for you to put your money somewhere? Now, clearly, when you say most people in the financial space, I think that's a good way to phrase it. But you got to realize most people in the financial space are in the stock market. They're selling access to the stock market and they want to manage your money. There's also a bunch of people in the life insurance space that are focused on selling term insurance. And the pitch to buy term insurance would also be buy term and invest the difference. Now, I'm not saying that there isn't a place for that. That can certainly work for some people, especially if you have a very strong conviction in the market or you're a very good buy and hold investor. Traditionally, if the market does what it's always done, that can work out. I tend to look at things a little bit differently, so I have different thoughts about it. But, for me, it comes down to the likelihood of success of your overall financial plan. And for me, buy term invest the difference leaves a little bit too much to chance.
Yes, and I think that's the big key here. It's not like I actually have a term policy that I've had for many years when I was having my first child. And it's cheap. I keep it. It's an extra $500,000 of life insurance that is certainly not hurting me. So I have no problem with term, and I have retirement accounts. I have brokerage accounts. I have all of those things. But when you say that mutually buy term and invest the difference versus doing something with whole life or IUL, that's where I have a little bit of an issue, because in many people's circumstance, something like IUL or whole life can be a good savings mechanism or a good hedge against market conditions. We've talked a number of times about sequence of returns risk. And so there's so many reasons that are just real good reasons to incorporate something like a high cash value life insurance policy.
I'm going to come at this from a slightly different angle. You and I advocate for specially designed high cash value policies if you're going to consider whole life or IUL. And most of the buy term invest the difference people point to that as a more cost-effective way to do your investing. You'll end up in a better position as opposed to the expensive designs of whole life and IUL that you're paying a lot of money for the actual life insurance. And while you do get some benefit for that, it's not enough. It's not enough benefit. But the designs that we do, we are almost effectively buying term so that we can go invest the difference. We're actually buying a very small amount of the permanent life insurance, so it comes at a very small cost. We blend in a large portion, as much as they will let us, of cheap term insurance, which gives us liquidity in our policies. We can fund at a very high level inside those policies. It turns those dollars into a safe growth environment that will just grow and compound for the rest of our lives. And we have liquid access to it so that we can go invest in other things. Essentially, we're buying term and investing the difference. That's my outlook on it.
That's a really good point that you brought up there. I think that is absolutely true in reality. And so to kind of dig into the numbers of it, a lot of the policies that we design, like my own policies and people that I work with, we're looking at 9-10 times the amount of term versus that base policy. And so realistically, that's why the majority of the premiums that we pay in is going into cash value. And in some way, now, not technically an investment, it is an asset that is accruing interest, whether it's in whole life or an IUL, and that can be used to even invest in other things, as James mentioned. That's where it would become investments, is you borrowing from that policy and investing in something like real estate or in the market, even if you want to. And so I think there's just so many reasons why that flexibility is super powerful when you're implementing this strategy.
Couldn't agree more. Now, I want to step back just a bit again. And despite the fact that I would call how we advocate for our designs is almost a buy term and invest the difference. Let's reanalyze that buy term and invest the difference, because I like to talk about it in terms of what is the likelihood of success. And if you're going to take a set amount of money to buy your term insurance so that you have that coverage in case something tragic happens to you, if something tragic happens to you, term insurance is like the best return on money that you can get. The designs that we do are only slightly less. They're still a really, really good return on investment. So it's not like you're throwing away a whole bunch of money, because nobody knew that that accident was going to happen. Term insurance, the reason it's so cheap is because it rarely pays out. So in this case, and in most cases, we don't actually expect it to pay out. So in buy term and invest the difference, it's just going to be a cost. You're not going to recoup that unless your investments do good. The likelihood of success, if you're using the buy term and invest the difference plan, is you have to then be a good investor. The hardest thing for people to be a good investor is to get over the human emotions that happen as part of that investing. It's so hard for people. And I was talking with a client today about the challenges that they face that often leads people to buy high and sell low rather than buy low and sell high. And that is that emotional roller coaster that we get on as investors when the market's riding high and everybody's excited and you just want to throw all of your extra money into it because you think it's just going to go up. And then suddenly it doesn't. And the market's crashing and it comes down so fast and nobody knows when it's going to stop. They panic and they got to get out as soon as possible. And that happens to be at a low point. So fighting that is a challenge. And they don't really talk about that when they advocate for that buy term and invest the difference. I think for the most part, they either just assume that you're going to be the type of investor that can handle that, or they don't care. They just want the opportunity to get your money so that they can try to sustain their business and hopefully help you grow before the next crash.
And I'll say that many of them do in this space will also say dollar cost averaging, low cost index funds. It's become a pretty popular thing to say now. And that's actually a good strategy for most people. If you're going to be doing something like buy term invest the difference, some low cost index funds, you can look up the different tickers for that or Google that. There's S&P based ones, there's NASDAQ based ones. There's so many different options that you could have. And if you just dollar cost average, which basically means you just set amount of time that you're going to buy, or maybe you're going to buy monthly, every paycheck. And that's how you enter the market, so that you're always buying in a down market and you're sometimes buying also in a high market. But in the end, those dollars will average out. And that is kind of how they mitigate for that risk. But in the end, if it is a brokerage account that you directly control, it can be hard. There have been times where I'm like, "Oh, man, I don't know." I mean, because I have brokerage, I have, my retirement accounts. There are times where I'm like, "Man, should I reallocate to money market or do something else or just move to cash?" Actually, right now, I'm holding a little bit more cash than I would normally. Just, I'm not this is not advice for your situation, but that's what I'm doing right now in many of my investments. And that's because I want to be ready to execute on something, and that can be helpful for my current circumstance. We all can have those different options, because what am I doing in my own life insurance? That's just continuing to grow. Like, I don't do any magic with those. My life insurance is, I can solidly know that at least my principal is protected, or I have some guaranteed growth and some solid growth even in bad years.
Yeah, there's no way to know if you are going to be the perfect investor that buy the term invest the difference will actually work. So we talk about diversification. Most of these folks that advocate buy term and invest the difference, We'll also talk about diversification, except for some reason, you shouldn't diversify into cash value life insurance. It should just be another different thing that's also available in the stock market that they can also manage, or that you can manage yourself, but keep that money in the stock market. Whereas Carlo and I, we definitely don't shy away from your low cost index funds. There's a reason those things work. We can talk about that. Maybe we should talk about that in one of these future episodes, why we might like those. But the diversification that we get by also utilizing cash value life insurance gives us the ability to stick it out, to try other things, to be a better investor in other places, because we have that safe spot for our money. It's a safe place that we can set aside any money that we want to just have as savings, build up and have that guaranteed death benefit for our beneficiaries. And we don't have to feel like we're wasting money, because I know in almost all of my policies, I've passed my break even point where I have more money available in those than I've paid into them. So in that sense, what has it cost me? Potentially opportunity cost? Okay, but who knows what that would have been? Because I don't know what I would have done with those dollars in the market if I had just put those into the market. I could have put them in bad investments. We know I talked about in the financial horror stories where I had an account blow up because of something that I did. That might have happened with all that money I put into my life insurance, and maybe I would have been out even more money in the efforts that I went through to learn about and get experience in the stock market. There's a lot of growing pains when it comes to becoming a good investor. And I just like what life insurance has done for me and our overall financial portfolio in allowing me to get through all that stuff and have a nice solid financial plan as the base of everything that we're trying to do.
Yes, and one of the things that is sort of related to that is that by having an element of de-risked assets in my life insurance, so I take swings on things that one of my positions, I had a position, part of it, I mean, I sold off as it was on the way up, but in the end, part of that position 10x because, and I would normally not just hold on to that kind of a position as it's drastically increasing by, 500, 600, 1,000%. And so I think that's another thing to consider when you have something like cash value life insurance that you know is solidly growing for you, that you know that if you wanted to execute on a big deal at any point, you could take a loan and get more into the market if you wanted to. For various reasons, it helps you have that hedge in your head to maybe take some swings. I don't those types of things are not a big portion of my portfolio, but they are enabled by the fact that I have that mental security blanket in my cash value life insurance.
A lot of good reasons to utilize that cash value life insurance as part of our overall financial plan. Anything else you want to add? Or do you have a call to action for our listeners this week?
I think I've said this in a number of episodes, but really assess your overall portfolio. If you can't do it on your own, reach out to one of us and come to an understanding. Figure out how much of this risk protected assets is made up in your portfolio. And I think that's something that is important for people to do and get an understanding of that and how much risk they have in their total assets.
I like that. It should be something that people regularly do. I call it the sleep number. What is in it? Are you diversified enough so that you can sleep in a down market? When the market's crashing, are you going to be losing sleep? If you're not, then you're not diversified enough. And you're not diversified enough into safe assets that are not correlated to stock market crashing or even the real estate market crashing, because those things can and will happen and have happened in the past. So be sure that you're covered. I would say check out the videos that we put out on our channels. We dig into a lot of numbers. So if you want to see what these types of things can do, an audio podcast is not a good place for us to just talk numbers. So we don't do it here. We're talking concepts and ideas, and we're trying to get you the information that you need so that you can go do further research and then fill in the blanks. You can find those blanks, a lot of them, on our YouTube channels where we actually go over the numbers for a lot of this stuff. So I would say check that out. That's my call to action. And next week, we're going to talk about how much life insurance should you have. Something we don't talk about too often on this channel, but it can definitely affect your overall financial goals when tragedy may strike. So we'll bring that up next week. With that, my name is James Barber. I'm your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
Thanks for joining us. Take care.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.